Joining us. This call is for quarter 3 results, which we declared a while ago, and these have been uploaded on the site, so you should be having the detailed investor presentation also with you all. So before we get into the numbers and then the Q&A, just a brief macro update, and I think the big headline is that the GDP growth seems to have bottomed out, and there are all indications of acceleration going forward. We've seen some lead indicators. For us, one of the big ones is the Purchase Managers Index, and of course we have a lead indicator within our loan book, which is the growth in our vehicle finance businesses, both showing very robust upward trending. So it looks like there's a implied growth of almost 7% for the second half of the year, which would take us the full year growth at around 6.5%. And after the initial hiccups, I think associated with the rollout of the GST and DMON, things seem to be coming back on track. The other big headline, of course, is a very strong hardening of the GSEC yields. In the last 3 months, they've hardened by almost 40 or 50 basis points. In the last 12 months, by almost 100 basis points in the last 12 months. And of course, the attribution of this hardening of yields is to, I think, the mop-up of the excess liquidity that was there in the market by the RBI. There are some concerns on fiscal slippage, and of course, rising commodity prices led by oil. This, of course, has a big impact, and you'll see some of that impact in the books of banks in the current quarter, and maybe going forward in the fourth quarter as well, as a consequence of the mark-to-market gains having been wiped out. The other headline that we saw during the quarter was really credit growth coming back to double digits at 10.6%. One, of course, we were talking about a favorable base effect, but also there's a retail growth of almost 17%, so there's good traction there. And certainly we are seeing working capital growth recovery, and additionally, I think some reversal of the bonds into bank credit because of the hardening of yields. So some shift of the credit surrogates into real credit. Recapitalization of PSBs, we see how that first lot of 80,000 crores is going to be given out. And I think the small print to be watched here is whether these bonds would qualify for SLR. And if they do, that will put more pressure on bond yields going forward into quarter 4 as well. So that's a very quick sort of mop-up of the macros. As far as our quarter is concerned, we had a steady quarter. The growth bottom line came up at 25%, and that was supported by a good growth of 22% in the core fee income. Trading income was lower, and that's why you see total fee income sub 20%, but core fee income was still up 22%, and net interest income grew by 20% as well. So the balance sheet crossed 200,000 crores for the first time, the footage, and in spite of that growth, we are seeing an increase in our return on assets, which went up from 1.9 to 1.96%. More importantly, the vector that we have kept for ourselves, budgeted for ourselves, is the return on risk-weighted assets, which are now nudging 2.4%, which was our target for March 2020. So I think the RORWA reflects the other feature, of course, is that for the last 12 months, if you see year on year, risk-weighted assets are almost flat, although the balance sheet has grown by 25%. I think this reflects the steadily improving risk profile of especially our corporate loan book, and the credit rating profile definitely improves, and that's visible in one of the slides that we disclose every quarter. I won't go into an elevator analysis of what went up and what went down, but as far as margins are concerned, the margin was steady. Net interest margin steady around the 4% benchmark. I already talked about ROA, and there's definitely improvement in ROE. Also, I think the earnings per share went up in accordance with the growth in the bottom line. There are two star features of the quarter 3 performance. One, of course, is the continued growth, robustness in growth in the savings bank balances. We added 300,000 new to bank savings and current account customers during the quarter, and that made up part of the 500,000 new customers that we actually acquired during this quarter. SA growth came in at 68% year on year, and that's why CASA is nudging for 43% now. The other feature is the growth in our vehicle finance book, which had become evident even in last quarter, but that has now surfaced in a very robust manner. Our disbursements on vehicle finance as a whole went up by 34% and grew 34% year on year in quarter 3. Just commercial vehicles grew, in disbursements grew 39% actually, commercial vehicle disbursements, I think. So the growth is now firmly in the 20s for the loan book as a whole. And I think the interesting feature is on vehicle financing that it's not just commercial vehicles, the heavy stuff. We're already seeing good, handsome growth in utility vehicles, cars, three-wheelers, two-wheelers, construction equipment, especially tractors. Tractors grew almost 58%. So that's a good sign for us, and that helps us to slowly sort of rebalance the book, which is our target. The ratio between corporate and retail has been stagnating at 60-40, whereas we have said that we go to a 50-50. So we see a 1% improvement in the profile of the retail versus the corporate banks, I think. Other than that, the digital sourcing part of our businesses also showed very good traction. 25% of the newly acquired savings bank customers during the quarter were acquired through tab banking. Almost 14% of our credit card businesses were acquired online. Almost 64% of our personal loan businesses are what they call pre-approved as well. We are seeing a very good traction on our mobile banking. We were a little late, as you would recall, coming up. Mobile banking now has grown 3x over the quarter, and we have 1.5 million sort of transactions now being done every month. So that part has also built up nicely. We can go through briefly the loan book. We open the slide in the loan book. And also the sort of profile of the So the loan book profile, as I said, only moves 1% in favor of retail. But I wanted to talk more about the diversified corporate loan book. There you would see a slight movement upwards on power generation, and that is caused by one account which has international bank guarantees for it. Other than that, I think the dispersal is almost the same as we saw last quarter, so you don't see too much of a movement there. Loan book quality is the other part that we talk about. Our gross NPAs moved up by 8 basis points. Although gross slippages have fallen. Slippages have actually fallen from, I think, almost from 1.7% to around 1.3%. Gross slippages have fallen, right? From from 1.7 to 1.32%. And credit cost actually came down from 18 basis points to 15 basis points, although gross NPAs went up by 8 basis points. The provision coverage ratio was kept at 60%. We've retained that. The restructured book is now down to 0.15%. It's a very small book. And the SR book, which is sales to the ARC, is about 440 crores, the total amount. So I think there's steadiness around the loan book quality. Individual, we also give you individual product-wise gross NPAs, and you don't see one movement. The big one is an improvement in the commercial vehicle side, where gross NPAs have actually fallen by about 9 basis points overall. Other than that, capital adequacy. Capital adequacy, actually the CRAR actually went up by almost 20 basis points, in spite of the balance sheet growing by 25%. The loan book actually grew by 25%. And that's because of the drop in the risk weightages. So I think it's a fair indication of what I said earlier on the way the trending of our loan book quality. If you see all this together with the fact that our SMA2 data is well below 1% of our book, I think that's a fair indication of where this book is actually headed. So that's on the CRAR. Anything else that we need to cover? Okay. I think the cost to income I've already talked about. Fee income, we've discussed. Core fee income has grown 20%. If you see the breakup of the core fee income, then all the vectors show pretty decent growth, except for investment banking. Investment banking is a lumpy business, so you can't expect uniformity in terms of its growth profile quarter on quarter. So that's it in terms of quarter 3 results, and we are open to questions.
Thank you. Ladies and gentlemen, we will now begin the question and answer session. Anyone wishing to ask a question may please press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We take the first question from the line of Kunal Shah from Edelweiss Securities. Please go ahead.
Yes, sir. Firstly, any clarity in terms of the...
sorry to interrupt, Mr. Shah. Sir, we're not able to hear you. Can you speak a bit louder?
Yeah. Is it audible?
Yes, thank you.
Yeah. So, in terms of the RBI's divergence report, have we already received it, and it has not been material enough in order to maybe disclose anywhere? Is that the case?
No. The RBI report is still awaited.
Okay.
So they completed the audit only towards the end of December, and they have not yet given us even the preliminary findings, the preliminary risk assessment report. So all that is still going to happen in quarter 4.
Okay, so that's going to come in Q4 if there are any divergence.
Yeah.
Okay. And secondly, in terms of this power generation, so whatever is the movement in the ratings which are there, is it largely on that account?
No. That is a guaranteed sort of exposure. We have international bank guarantees to do that. I just wanted to explain that there is one account which actually moved the percentage of exposure to power generation as a percentage of our total loan book.
Yeah, but in terms of rating, it is not impacting because there is some...
No, not at all.
Okay.
So the rating profile actually shows an improvement.
That's why he's saying that because the guarantees is showing an improvement.
No.
That is one of the contributors. It's not the only contributor.
That's only one. But a lot of it is because some lending has happened to the PSUs, and also PSUs have higher rating. So that also, you can see it in the, what slide is that, where we give the rating profile of the bank.
Yeah, that's true. So if we just look at the rating profile, there is some inch up away from, say, AA and AA minus towards A minus and A minus exposure. So anything to read into that, or maybe it's more like, say, the financial statements would have come in, and that is where we would have reviewed the entire rating, and nothing much to worry about in terms of this kind of a shift which has been there. So the rating downgrade which has been there, 2 to 3%.
Yeah, I think there's a little bit to celebrate there, rather than worry, because the rating profile has actually improved. So the rating profile of the whole portfolio actually now veers around to around A minus.
Yeah, it's there more towards A minus. Initially,
Yes.
it was more towards AA and AA minus. So that's the only
No.
No. Overall, we're talking about the whole portfolio.
The average portfolio, Kunal, is A.
A minus. Okay. So you are saying quarter on quarter there is no deterioration as such.
There's an improvement.
There's a very marginal improvement.
Okay. And thirdly, in terms of this commercial vehicle, so much stronger traction. So how much do we see it structurally, and just the maybe we would tend to believe that the cycle has just begun, and how much of it would be, say, on account of some kind of a preponement of the demand which would have been there in, say, Q3. So is it more kind of a structural, and we should see it continuing for a while?
There's no reason for preponement. It's not a year-end kind of situation. Therefore, I suppose it's a bit structural, but we'll have to wait for a couple of quarters to see whether it's a trend.
Okay. Yeah. Thank you.
Thank you. We'll take the next question from the line of Manish Ostwal from Nirmal Bang. Please go ahead.
Thank you, sir. Thank you for the opportunity. My question on the loan book growth during this quarter, and thereafter your comments during the press conference that now you are seeing the firm growth in the corporate side also. So how do you see the growth in that context? Because the industry was growing 4-5%, we were growing 25%. If the environment is good, we can reach to 30% kind of growth again.
So if you look at our record for 10 years,
yes,
you see that whether things are going up or going down, we are steady at 25%.
Right.
So the fact that we grew 25% 3 quarters ago, and now things are looking up, I don't think we are going to press the pedal and push the loan growth to 30%. What we will do certainly is that to rebalance the book.
Right.
And that book rebalancing means that hopefully the retail part will grow faster than the corporate part. And we go back to that target of achieving a 50-50 balance between this in the next 2 years.
Sure, sir. The second question on the operating expenses growth. Last many quarters, the growth rate is trending down, and now it is 15% YOY growth. And we have maybe it is a big function of some digital initiative that is also paying off in terms of lower cost of acquisition and the servicing of those clients. So how do you see the operating expenses growth given this digital acquisition trajectory, and the second is the overall efficiency in the bank?
So our FT per branch, and which is a good indicator which we take to measure, has gone down by 20% per branch over the last 12 months. If you have to see the data, our FT per branch is down, and it will continue to go down as more and more digital.
These full-time employees.
Full-time employees has gone down, and as we grow our business, I think, and as we get into digital more and more, I think this will continue to go down. Ramesh has already informed you that 25% of our savings account, 65% of our PL, and 15% of our credit cards are now acquired digitally.
Right, sir. Last question on the microfinance book. We now crossed 3,000 crore of microfinance book. So how the asset quality in that book, whether the things are improving from the quarter 2, or it is stable? How's that trend in collection efficiency terms?
Yeah, no, the asset quality is very good actually. So, in fact, all our loans which have been booked after January 1st, the repayment rate remains at 99.8%. Yeah, January 1st, 17
Yeah.
remains at 99.8%, and in fact, we have been seeing some recoveries also now for the earlier provided NPAs.
Okay. And last point, sir, what is the update on Buyer Finance merger, sir? Where we are right now in terms of stage?
Yeah, so we have we made a disclosure to the stock exchange that we have received the approval of the Competition Commission. That happened very quickly. We are still awaiting approval from the Reserve Bank, after which we can move towards the next stage of approval, which is the stock exchange approval and finally the NCLT approval. So it's moving through the motions in Reserve Bank.
Okay, sir. Thank you very much. All the best.
Thank you.
Thank you. The next question is from the line of Ashish Sharma from Enam Asset Management. Please go ahead.
Yeah, hi. Good evening. Thanks for the opportunity. Just on this interest income, the revenue growth, where we have seen some bit of disappointment, 16%. And if I just see your yield for both corporate and consumer finance, we are seeing some bit of pressure there. Just some color on, is it more to do with the private and public sector banks being little too aggressive in the corporate space? Do you see further tightening there? Just some color on that, sir.
Yeah, so I think the number you quoted is not exactly right. The net interest income growth was not 16%.
No, sir, interest income, not net interest income. Only interest income. If I just to compare it with the...
earned, yeah. It's earned. Right. Okay. And the second part, of course, you talked about the I think the yield reduction.
Yes.
Yeah, so there is a yield reduction, but simultaneous with that is also a cost of funds reduction. So net the margin has been almost negligible. It's been about 1 basis point. But specifically, I think there are some pockets in consumer finance where I think the spreads have become, in some segments, slightly more competitive, notably in products like LAP, and I think in one segment in the vehicle business as well.
Okay. The other point was that given this cutthroat competition more on the corporate side, where even the yields have gone below 9%. So do we see that risk adjusted there is still it's still a segment where we can focus, or because in this quarter the growth, the loan book growth was faster in the corporate book rather than in retail book. So
absolutely. I mean, just don't look at interest income. Look at the non-interest income that flows along with it. So when you look at corporate relationships, you don't just see the interest earned out of it. You also see the return on your exposure, return on assets. And that is there because fee income has a lower risk weightage and therefore returns go up. So certainly this is an area that we like to grow because the fee pools are much larger in the corporate bank.
Okay. So risk adjusted, it is still, I mean, including the fee part. This looks perfect.
Not just the fee part, but also the OPEX in the corporate bank is much lower than the retail bank. So from a bottom line perspective, returns are pretty attractive.
Perfect, sir. That will be all, sir. Thanks for the opportunity and all the best for the next quarter.
Thank you.
Thank you. The next question is from the line of Dhaval Gala from Birla Sun Life Asset Management. Please go ahead.
Thank you, sir, for the opportunity. Couple of questions. First question on your yields. Could you tell us what would be incremental or marginal yields both in corporate banking business and the consumer banking business? And how is the trend like on the incremental versus the average yields which we report?
So we don't disclose individual items, Dhaval, in terms of the product yields. But I think the takeaway really is what's happening to funding costs and what is happening to yields. And I think the net result of that is your NIMs. So that's how you run the business.
Just to ask you, maybe the recent move in the interest rates, more in market rates especially, will that have a considerable impact in times to come? Looking at our portfolio yields reducing right now much faster than the book yields on the basically the means average yields.
No. So the margin is also a function of your mix, and I think it was mentioned earlier that the retail businesses are starting to grow faster. And
Right.
if you look at the differential yield is almost 5% between retail and wholesale. So that's certainly going to give you a little bit of a cushion.
All right.
At the end of the day, your consumer finance, the retail part is yielding 14%. Right, which is clear over 5% spread over the corporate side. And the more you do on the retail side, you take care of the competitive pressures that are coming on the corporate side. There are some, as Sanjay mentioned, some competitive pressures in the retail side also, but the higher yielding assets are still holding up nicely. It's just the area of commercial vehicles, etc., where a few players have sort of come in. They are opportunistic, and they will last for maximum 6 months.
All right. So the other question, more on your corporate asset quality as such. Could one expect no more challenges from here on? Because we look at our portfolio mix in terms of diversity of sectors, and most of the NCLTs and the divergences, etc., for the other corporate banks largely done with. You would not have material things left. So should one expect lower slippage ratios for you on your corporate exposures in the coming years?
See, on the BAU basis, if you look at the steady improvement in the rating profile of our corporate loan book over the last 3-4 quarters, look at the fact that we have a high provision coverage ratio of almost 60%. We have a floating provision of 70 crores. We have got SMA2 at well below 1%, as I mentioned. So there is no reason why the BAU credit cost should not actually remain either stable or move downwards. The other element is only the divergence element. If there is divergence, if we see finally from the RBI report, this thing of the divergence can only be of a technical nature and not really credit related this thing, because our SMA2 data reflects that. SMA2 data is well below 1,000 crores, right? So there is no reason why for us to believe otherwise, that the loan book quality has improved, and therefore there should be a steady improvement in the the credit cost profile.
Sure, sir. Thanks a lot, sir. All the best.
Thank you.
Thank you. We'll take the next question from the line of Shivakumar from Unifi Capital. Please go ahead.
Yeah, thank you for the opportunity. Sir, my question is regarding the Bharat Financial merger. You had given a list of approvals that are yet to be sought from the regulatory authorities. I just wanted to know the broad timelines which you have in mind. Will you be able to complete this before the Q2 of next fiscal?
Yeah, that is the plan.
Okay, or it can be even much before that, sir? So when do you believe that RBI will be able to approve the merger?
It's possible, but I think I can't second guess how soon RBI can approve it. So I think that would be a bit of guessing.
Okay, but you're confident that by Q2 you'll be able to get all the approvals, right?
It looks like that.
Thanks, sir. Thank you, sir.
You're hoping for that, yes.
Thank you. Before we take the next question, we would like to remind participants that you may press star and want to ask a question. The next question is from the line of Anusha Raheja from LKB Securities. Please go ahead.
Yeah, thanks for taking my question. So one thing on this margin side,
sorry to interrupt, Anusha. Can you speak a bit louder?
Yeah. So on the margin side, how do you see margin shaping up, for the next fiscal? You mentioned that, you're moving more towards the retail book. So once the mix improves more towards retail, like 50/50, where the yields are better, how the margins will, shape up?
Yeah, so our sensing is that margin is going to remain stable because we are seeing yield pressure on the corporate side of the business, and even while the mix changes, I think this will sort of neutralize it. The other big kicker that can come in to improve margins is the CASA. This thing, CASA is almost 43% now. Our target is to take it to 45%, and if that happens, then I think certainly there is an upside possible, provided there is rational pricing in the market.
Okay. And so one thing on this, NPL that has come on the consumer lending side, it was 213 crores in Q3FY18, and now it's around 266 odd crore. So anything more to read into it, like there is a rising trend there?
Well, I think we also given you, on the next slide, we have given you a breakup.
Consumer NPAs have fallen quarter on quarter. They were 1.19% in quarter 2, and at an aggregate level, they are 1.1% in quarter 3. And in the products, there are some movements. CV has slightly come down, LAP has slightly gone up, but they are all within sort of comfort zone.
Okay. Okay, fine, sir. Thanks.
Thank you. We'll take the next question from the line of Monica Agarwal from Bernstein. Please go ahead.
Good evening, sir. So you just mentioned about CASA ratio that we're aiming at 45%. By when is this target? Are we planning to achieve this particular target?
This is the target if you recall, when we presented our plan, we had said that we will cross 40%.
40%, right.
Now that we have crossed 40%, it's on the table on whether we should be upgrading our target. So we are saying that we should be aiming at least have the ambition to achieve 45%.
So 45% by FY20, right?
Yeah, it's an ambition.
Okay, great. The second question is on the credit cost. So apparently there is a slight bit uptick on the consumer finance portfolio. So where is it exactly coming from? Which particular sub-segment that you would highlight that from where is it coming from?
Actually, if you see if you have a slide, if you have the investor presentation 23, you got the NPA composition of consumer finance. You see where the gross NPAs are moving. So you see commercial vehicles actually has gone down, utility vehicles has gone down, construction equipment slightly up, cars is actually gone down, two-wheelers slightly up, LAP, etc. is up by about 15 or 20 basis points, 19 basis points. So that's the breakup.
Okay.
The values, individual values are pretty small.
Okay, so just one last question on the investment side. If you would be able to give me the breakup on the investment portfolio of how much percentage of it do we have on held to maturity, held for trading, and available for sale? Do you have some percentage share on these terms?
No, we don't give those details. You can see it on an annual basis in our balance sheet. But we do disclose the trading income every quarter. And that has been, if you see the investor presentation, it has been lower, obviously because yields have hardened this quarter significantly.
Okay. That's all from my side. Thank you so much, sir.
Thank you. We take the next question from the line of Jay Mundra from B&K Securities. Please go ahead.
Yeah, hi sir. Thanks for the opportunity. Sir, just two questions. First, you explained a bit about the Bharat Financial merger. Just to understand from our reporting perspective, would it be safe to assume, so let's say next quarter also we would be reporting our number itself only, and once the merger gets the final approval, we would be restating the, let's say, at least the fourth quarter number or FY18 number? Because the approval date is 1st Jan, I believe.
You are absolutely
Yes.
correct. Yeah, that's right.
Sure. And secondly, sir, just one data point. If you can share the security receipt number, or if there any change in this quarter for our bank.
440 crores.
440.
Total. And we sold 40 crores.
Sure. And just to reconfirm, there is no SDR 525 and other deferred kind of a stress, right? Except this restructuring.
No, only 0.15 of restructured book.
Sure, sir. That's very helpful. Thank you.
Thank you. We'll take the next question from the line of Amit Premchandani from UTI Mutual Fund. Please go ahead.
Good evening, sir. Thanks for the opportunity. Just wanted to understand what is the management thought process about manufacturing of different financial products like insurance and asset management?
Yeah, I think there is a internal debate that we have done well as a distributor of these products, and where does the value really reside? Does it reside in the annuities that you earn as a distributor, or does the value reside in the manufacturer? And certainly I think that debate is now on, and clearly there is seems to be a strong case that we should also be getting into manufacturing. Which means that should we be a life insurer or a non-life insurer ourselves? Should we do asset management ourselves? Should we do brokerage ourselves? These things are now on the table. I mean, if you would ask me 1 year ago, they were not on the table. And certainly there's a discussion now going on. And from those discussions, I think some actions will emerge.
And sir, largely, from a thought process point of view, you would like to have organic way of growing these books or inorganic?
We will look at both. But where there is long gestation, we would prefer inorganic growth.
Thanks. Sir, another question on IFRS. What is your expectation about the timelines of IFRS? And are you reporting fee income in line with IFRS, or you are following the old or the current prevalent practice?
See, on IFRS, RBI has not given any the timeline. As it stands, it is going to be effective from 1st April 2018. That you are all aware about it. But there is no revision in the guidelines and all that. So as long as that is not made applicable, we continue to report the earnings on the Indian GAAP accounting system, and we do not find that there will be big divergences if we converge into the Ind AS.
Thank you, sir. That's it from my side.
Okay.
Thank you.
One more question.
Thank you. Ladies and gentlemen, due to time constraint, that was the last question. I now hand the conference over to Mr. Romesh Sopti for his closing comments.
Okay, thank you for joining us. I'm sure you have more questions which we discuss on a one-to-one basis. Good day. Thank you.
Thank you. Ladies and gentlemen, on behalf of Indusind Bank Ltd, that concludes this conference call. Thank you for joining us, and you may now disconnect your lines. Thank you.